2 weeks ago, Chipotle did something very smart, although few in this business will admit it. They announced a 50-for-1 stock split. In theory, splits don't matter. They don't change anything except the optics of the nominal share price. Hey, but in practice, lots of investors hate buying high dollar amount stocks. A 50-for-1 split will lure in new investors, which I think is why Chipotle shares caught fire in response. Now, even though the stock's pulled back about 5% from its post-split announcement peak, it's still up more than 15% since we last spoke to them in February, after the company reported a fantastic quarter. So could have more room to run? Let's check in with Jack Hartung. He's the Chief Financial Officer and, by the way, Administrative Officer of Chipotle. To learn more, Jack, welcome back to Mad Money.
Hey, Jim, great to see you.
All right, first, Jack, thank you for bringing back Al Pastor, which we've had immediately. It's unbelievable. I'm sure the results, once again, are stellar.
Fantastic. It was one of the favorites, Jim, and I couldn't tell you about the celebration that people found out we were bringing it back. So, yeah, it's a big hit.
All right. Now, let's talk about something that is a big hit in our world, which is you did something that I know we've been urging people to do, CEOs, which is do a stock split. And a lot of them, they just come back and say, Jim, it's too expensive, too costly. The big funds don't want it. And not only that, you can go buy a fractional share. We've countered by saying that Sam Walton didn't feel that way. And Sam Walton, one of the greatest investors and one of the greatest creators of our time. So could you give us the history of why you felt it was okay to do?
Yeah, Jim, we study this every year or so. We have our bankers come in and we talk about the pros and cons of doing a split. And cost was never really a big problem for us, but we couldn't really find a compelling reason until recently. And there's two reasons really that led to this split. One is our employees. It was getting harder and harder for us to get the right denomination because we reward our top performing managers with stock in the company. We want them to celebrate our success with us. And it was getting harder and harder, where if you wanted to reward a manager with $4,000 worth of stock, you'd either have to award $3,000 or $6,000. So that made it a challenge. And also, when their stock would vest, the withholding made it tough, too, because the withholding could only happen in full value shares. And so if you had, let's say, let's say you had $3,000 worth of value that was created, the only withholding you could accomplish was one full share, which basically would wipe out most of the value. And so for that reason, that was a big reason for us to do it. The second one, though, about a year ago, our investors started telling us that separately managed accounts were a real problem to get liquidity. These accounts typically, I'm sure you know this, Jim, they tend to be small. They tend to be in the 50,000 to 100,000 range. But in total, they're the fastest growing investment class. And they total now over $2 trillion. So it's a lot of small accounts that add up. So if you've got a $50,000 account, your choice is either to have no exposure to Chipotle, or you have to over-index and get a 6% exposure to Chipotle when our stock is trading at 3,000. Those two reasons combined, Jim, cause us to say, let's do it. Let's go ahead and do the split.
Well, that's somewhat remarkable. We've been doing pieces all day today about how the investor class has gone to the point where it's now 58%. And I always found it curious because I said, well, geez, what are they buying? And you've hit the nail on the head. They're not buying these multi-$1,000 stocks. And yet those are some of the best stocks. Now, did you get any pushback from some of the big mutual funds to say, hey, listen, now we pay per share, and you just hurt us?
Not one, Jim. In fact, we were with some of our investors last week. We didn't have one question, one comment about it at all. And generally over the years, when we talked to our largest investor, they were largely indifferent. A few of them brought up the separately managed accounts. But other than that, our largest investors, they care about our growth. They care about our results. They care about that we're still going to deliver on our promise of cultivating a better world. As long as we deliver on those strategies and deliver the growth that they've come to expect from Chipotle, they're very happy with the split.
Well, I imagine when you're going from, say, that you think you do $3 million, you're doing $3 million per average unit to $4 million. And if anyone is unhappy about that and doesn't want to pay up because of a couple of pennies more, they're fools. What's the roadmap to $4?
Yeah, the $4 million, Jim, it's going to be a lot of more of the same. The single biggest opportunity we have is to run great restaurants. And right now, we're at a stage where our managers have really rebuilt this muscle called throughput. Throughput has been really a hallmark of Chipotle. People love the Chipotle food. The only thing they don't like about Chipotle is walking in and having to stand in line. When throughput is really working for us, which, again, it's early days, but our managers are doing a fantastic job. We're seeing some of the fastest throughput we've seen in a number of years. And that means more customers in the front line. Of course, our digital business is still almost 40% of our business. So now we've got two significant businesses that are working really, really well at the same time. Of course, we'll still have a couple LTOs every single year. Our marketing team will continue to emphasize our real cooking from scratch, our real ingredients, and they'll continue to feature our employees in our restaurants. And that's a great branding message. And then we've still got our digital, access point as well, including our loyalty members, which is now approaching 40 million members. So we have a lot of levers to pull, but I would say the number one is just running great restaurants every single day, including great throughput.
Now, you have done really amazing things with robots. I mean, when I was out and watching Jensen Huang and NVIDIA, I was thinking they should be learning from you. I mean, you created these Chippy you created, right? And then the avocado maker, you created that yourselves, right?
Yeah, so avocado, we're working with some outside parties, but we're making investments in these companies as well, Jim, so we're co-creating with them. What we're trying to do is make sure we maintain the essence of cooking in our restaurants. Like, for example, we're not going to have guacamole made outside the restaurant and brought in. But if we can make our teams' jobs easier so they don't have to spend as much time cutting, coring avocados, they'll still hand mash it. They'll still cut the peppers, by hand. They'll still cut the onions by hand. The guacamole you have at lunch is going to be made for you in that morning. But the idea of avocado will take away a time-consuming and a less pleasant task for our employees. There's another opportunity that we're looking at as well, and we're co-developing from a technology standpoint with Hyphen, and it's really automating the DML, our digital make line. So we have, as I mentioned, we have nearly a $4 billion business on our digital make line. We're making a lot of bowls, on that line. And if we can make that easier for our team, so at least the bowl making opportunity is done automatically, and then they can make sure that our crew can make sure that the sides are done accordingly, that we roll the burritos, make the tacos, the things that a Hyphen wouldn't be able to do. It's going to make their jobs a lot better.
All right, Jeff, one last thing. Obviously, the California law comes into place today. You do have to raise the salaries of people in California. Have you budgeted that for the year, how that will go, and you ready for it?
We're ready for it. We haven't raised yet, Jim. We didn't want to raise prices on April Fools for obvious reasons, but this week we will take an increase. Our approach was going to be just to break even, just so we can offset the impact. It is a significant increase in wages. Even though our wages are generally above others, it's still going to be a high teens, almost 20% increase. We do think we will fare well in this. We do think that we offer a great value. In California, even though costs of doing business are higher in California, a burrito before this price increase is about the same as it would be in the middle of the country. So we've had great value in California. We're going to have to spend some of that value, though, to try to offset some of the wages.
I understand. Now, just so people know, I think this is important, that if you had invested $750 in your stock, it'd be when you came public, it's worth about $100,000. And I think that anyone who's worried about what a stock split could do from the institutional point of view ought to think about $750 going to $100,000. Well played. Jack, it's great to have you back on the show. Good to see you.
Good to see you, Jim. Thank you.
That's Jack Hartung, CFO of Chipotle. What a story, guys. And now you're going to be able to buy it in the split, which is what we really want, because we know that you don't want fractional shares. You want the real deal. Mad Money's back after the break.
When we return, master the markets one stock at a time. The lightning round is up next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.